Welcome to this explainer. Today we're diving into what I think is one of the most fascinating corporate finance stories we've seen recently. We're going to track exactly how the Adani Group navigated a really sudden major credit crisis, only to bounce back, post record-breaking financials, and then almost immediately plot out these massive future expansions. Honestly, whether you follow corporate finance religiously or you just want to understand the nuts and bolts of how mega conglomerates actually weather massive storms, you're going to find this super interesting. Let's get right into it.
All right, so here is our roadmap for today. We're going to start with the credit rating rebound, then we'll move into those record-breaking FY26 numbers, look at the core infrastructure driving that growth, unpack exactly why the rating agencies changed course, and finally look at how they're fueling the next phase.
Okay, kicking things off with Section 1, the credit rating rebound, and how they navigated that U.S. indictment fallout.
Picture this. It's late 2024, and following news of U.S. indictments involving senior executives over at Adani Green Energy, the market completely panics. Major global rating agencies, I'm talking S&P, Moody's, Fitch, they react instantly, putting multiple Adani entities on rating watch negative. But then, fast forward through 2025, and we see a literal 180-degree reversal. We're talking sweeping upgrades back to stable and even positive across all those major portfolios, plus entirely new global ratings being issued. It's pretty much a textbook example of a rapid credit recovery.
Let's actually trace this timeline, because it's wild how fast these agencies flipped the script. It all started in November 2024 with that negative watch. But look at this. By March 2025, Fitch had already revised 4 major infrastructure entities back to stable. By August, Mumbai International Airport got bumped up to BBB plus stable by Carriage. And then, by December 2025, the dust had totally settled. All portfolio EBITDA, which is basically their core operational profit, was either reaffirmed or upgraded globally. The group says this sheer speed was all down to transparent dialogue and just proving they still had open access to funding.
Moving right along to Section 2, record-breaking FY26 numbers. Let's look at the financial anatomy of this resilience. Okay, grab your calculators for this one, because the standout figure here is 152,967 crore rupees, which is roughly 16.1 billion US dollars. That right there represents the highest ever annual capital expenditure by any Indian corporate in history. Think about that for a second. In the exact same fiscal year they faced this massive credit scare, they didn't pull back, they didn't hide. Instead, they deployed an absolutely unprecedented amount of capital to build new assets.
And how did they afford that? Well, it turns out that massive spending was backed by an all-time high EBITDA of nearly 95,000 crore rupees for FY26. That's a 5.6% jump year over year. So what this proves is that while the stock market and the bond ratings were just fluctuating wildly out of control in late 2024, the actual day-to-day operational profitability of their businesses was basically untouched. In fact, it kept growing.
If you're wondering where that growth came from, take a look here. That operating profit growth was heavily driven by the transport sector, anchored by Adani Ports, which absolutely led the charge with a massive 23.2% year-over-year jump. Adani Enterprises' infrastructure grew by 13.8%, and utilities kept a really steady 4.6% growth. Remember, this isn't just top-line revenue, this is operating profit growth across some seriously heavy-duty, complex industries.
Which brings us nicely to Section 3, core infrastructure driving growth. Basically, finding stability in the middle of all that volatility. Now, this is absolutely crucial to understand. A staggering 87% of their total EBITDA comes from stable core infrastructure. We're talking power transmission, ports, solar farms, airports. These are essential services, right? And they're often backed by really long-term government or corporate contracts, which gives them massive visibility. To zoom out for just a second, if you have money in an emerging markets index fund, these are exactly the types of rock-solid corporate structures protecting your cash. When headline risks are swirling everywhere, this 87% is the engine that keeps the cash flowing reliably.
Let's break down the heavy hitters within that core. As you can see, Adani Ports and Adani Power are absolute beasts, each generating over 20,000 crore rupees in a single year. Adani Green Energy is another major standout here, growing its operating profit by almost 15% as they push their operational capacity to over 19 gigawatts. Honestly, the sheer scale of these individual entities acts like a giant financial shock absorber for the rest of the group. All right, Section 4, Why Agencies Changed Course. Let's pop the hood on the corporate finance side of things. So how did they convince the conservative rating agencies so fast? 2 words. Actually, scratch that. Two technical concepts: ring fencing and cash flow waterfalls. When you hear these terms, just think of a financial quarantine. These are super strict legal protections built directly into the bonds of the subsidiary companies. They basically say, hey, no matter what crazy legal or headline risks the parent company is dealing with, the cash generated by this specific port or this specific solar farm stays right here to pay back its own bondholders first. It safely insulates the physical assets from the parent company's drama.
Fitch explicitly pointed to these exact protections in their March 2025 reports. But, they didn't just take their word for it legally. They looked at what the company was actually doing. Fitch noted the successful refinancing of massive loans, like the $329 million Australian dollar loan for the North Queensland Export Terminal, well ahead of maturity. Adani Green Energy also managed to lock down $1.1 billion in long-term onshore funding, right in the middle of the crisis. By completely neutralizing their refinancing risks, they basically gave the agencies absolutely no choice but to restore the ratings.
And here is the ultimate proof that the financial trust was completely restored. Despite the late 2024 panic, the group's overall borrowing costs actually dropped to 7.8% in FY26. That's down from 9% just 2 years prior. Let's be real. You do not get cheaper debt in a high-interest rate environment unless lenders completely implicitly trust your cash flow.
Finally, Section 5, fueling the next phase. Let's look at their double-down expansion strategy.
So, the ship is steadied. What's next? Well, they're going on the offensive. Step 1, Adani Enterprises executes an immediate 25,000 crore rights issue. That's essentially giving existing shareholders a chance to buy more shares at a discount to raise a ton of fresh cash. Step 2, they use that war chest to incubate super capital-intensive infrastructure, like copper plants and data centers. Step 3, they pave the runway to eventually spin off and list their mature businesses, specifically targeting a 2027 listing for the airports division. And Step 4, following that up with a massive spin-off of Adani New Industries, which holds their entire green hydrogen ecosystem.
To really understand the why behind all this, we got to look at a sum of the parts valuation. That just means valuing each piece of the business separately to see the true worth of the whole pie. Analysts are heavily weighting the massive potential of that green hydrogen ecosystem, valuing it at over 1,100 rupees per share and the airports business at 970 rupees per share. By spinning these off down the line, they unlock all this trapped value for their shareholders.
Add all of those strategic moves together, the disciplined debt management, the record operational profits, the massive incubation pipeline, and it completely justifies Ventura's super aggressive 24-month target price of 3,433 rupees per share for Adani Enterprises. That signals an immense amount of growth headroom. We're talking about a potential upside of over 40% from recent trading levels, according to these analysts. So, I want to leave you with this thought. We've just watched a company take a major reputational and credit hit, use its underlying physical assets and structural finance to completely buffer the blow, post record earnings, and then immediately pivot straight into an aggressive capital raising and spin-off cycle. It really makes you wonder, is this strategy of relentlessly doubling down on core infrastructure the ultimate blueprint for how modern mega conglomerates bounce back from a crisis? It is a truly fascinating case study. Thank you so much for joining me for this explainer, and remember, always keep questioning the numbers behind the headlines. See you next time.